Equity Management Academy. September 22, 2021. Gold. To taper or not to taper, that is the question. Summary. The FOMC meets today and Chairman Powell will let us know about the future of tapering, and whether interest rates are going to go up, down or stay the same. We believe that the Fed cannot raise interest rates. We are at a pivotal point in terms of the credit markets, and raising interest rates at the same time we have a debt ceiling deadline does not make sense. The FOMC meets today and Chairman Powell will let us know about the future of tapering, and whether interest rates are going to go up, down or stay the same. Our guess is that markets may initially be bearish if there is any kind of tapering talk. We believe that the Fed cannot raise interest rates. We are at a pivotal point in terms of the credit markets, and raising interest rates at the same time we have a debt ceiling deadline does not make any sense. The markets are volatile in anticipation of any change in interest rates. The Fed does have an enormous influence on the markets, as today shows. The 10-year note has been trading at about 130, and we are looking at the CPI coming out at about 5.3% inflation. Based on current inflation, purchasing power is declining fast. We are still getting supply problems that are causing price inflation in addition to monetary inflation, which is caused by the Fed's massive stimulus being pumped into the economy. The more money the Fed creates, the more the dollar's purchasing power declines. Since Nixon took the dollar off the gold standard, the US has been exporting inflation to the rest of the world. After decades of the US dollar being the world's reserve currency, that dominance is in decline. The Fed may put a cap on the 30-year bond to cap interest rates, so debt payments remain manageable. In terms of inflation, we are in a situation similar to the 1970s, but we didn't have such debt levels then as we do today. In the 1970s, Chairman Volcker raised interest rates into double digits, but if that was done today, the defaults on loans would destroy the global economic system. With inflation rates where they are, we are in the land of negative interest rates already. Even if interest rates went up 1%, the increase in debt payments would cause defaults around the world. If anything, the Fed may need to bring interest rates even lower into even more negative territory when inflation is taken into account. It is unclear how we are going to be able to continue to take on more and more debt, while printing money to pay the interest. Fiat currencies, such as the dollar, which is solely based on trust in the government, are in dire straits. We are still dealing with the Delta variant and there are still labor shortages. Government support may be contributing to the labor shortages, although there is some discussion of a universal wage for everyone. We could be in the midst of some major changes in the world's economic structure. One solution to the declining purchasing power of the dollar is to slowly end tapering, which if Powell announces that today would be a surprise. Whether it is the time now to do that is highly debatable, especially with Evergrande possibly defaulting on $400 billion of real estate in China. Given China's questionable reporting practices, the amount is probably far more than the announced amount. Could this lead to a spreading contagion? Will China be the catalyst that starts a widespread collapse? It could happen quickly and suddenly. Or it might be contained to China. Our belief that interest rates will not go up. It is impossible for them to go up at this point. The Fed can't even consider raising interest rates, since doing so would cause massive sell-offs in equity markets around the world. They also can't end tapering, or the markets will plunge, which the Fed does not want. At this point, there is little the Fed can do. The Fed may talk about raising rates and slowing tapering, but such talk may be a tactic to attempt to slow inflation. Money continues to pour into precious metals, fine art, real estate, and other hard assets. Price and monetary inflation are not temporary. They are here for a while. That is why money is pouring into hard assets in an attempt to avoid losing value in relation to inflation. Even though stocks, real estate, Bitcoin, and other assets are rising fast, much of that increase is due to the declining value of the dollar in which such assets are priced. The Fed says that inflation is temporary. It does not seem to be that way. The economic system is changing and is coming to the end of a 40-year cycle that signifies a change from the US dollar dominating the system to a new system with multiple currencies and assets serving as the world's reserve currency. The IMF is preparing additional capital to countries that may require it. The IMF is expecting more crises, especially in third world countries. The IMF is making available trillions of dollars in special drawing rights, SDRs, as a currency to back up central banks around the world. SDRs appear to be being used as another currency of sorts. There is some concern that SDRs may replace gold, but gold has been around for thousands of years as an asset and currency. It seems highly unlikely that gold will ever go away as a currency and asset. All of these factors are increasing interest in precious metals. Such fundamentals are bound to increase the price of gold and silver in the long term. Every time precious metals have a correction, we buy physical gold and silver on a steady basis for the long term. Precious metals are critical to preserving your wealth for the long term. Unlike the dollar and other fiat currencies, or even Bitcoin, which is so volatile as to make it a highly questionable long-term asset, gold and silver have a long history of maintaining their value, especially in times of crisis and change, like we are experiencing today. We recommend taking advantage of pullbacks in gold and silver to add to your long-term position in precious metals. If in response to the Fed meeting gold moves down to $1,761 or even $1,748, the variable changing price momentum indicator, VCPMI, by 1 and 2 levels, then it will be an excellent time to buy. If that happens, then the targets will be the VCPMI sell 1 level of $1,794 and the sell 2 level of $1,835.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.
I wanted to share this report as it covers quite a bit of territory in terms of the current fundamental developments that are going on in the market. I want to take a look at the report that basically came out this morning regarding China. Top regulators ban crypto trading and mining. Bitcoin stumbles. China has been talking about regulating the crypto markets for some time now. And obviously now we see clearly what their intentions are. China's most powerful regulators on Friday intensified the country's crackdown on cryptocurrency with a blanket ban on all crypto transactions and crypto mining, hitting Bitcoin and other major coins and pressuring crypto and blockchains related stocks. 10 agencies, including the central bank, as well as banking, securities and foreign exchange regulators, vowed to work together to root out illegal cryptocurrency activity, the first time the Beijing-based agencies have joined forces to explicitly ban all cryptocurrency-related activity. China has been known to go to extremes with either very assertive statements and prosecutions to complete radio silence, says Georgia Zaria, CEO of Bequant Crypto Exchange in London. This time, the point was made very clear that China will not support cryptocurrency market developments as it goes against its policies of tightening up controls over capital flow and big tech, he said. The People's Bank of China, PBOC, said cryptocurrencies must not circulate as traditional currencies and that overseas exchanges are barred from providing services to mainland investors via the internet, cutting the likes of Coinbase and Binance off the world's second largest economy. The PBOC also barred financial institutions, payment companies, and internet firms from facilitating cryptocurrency trading nationally. The Chinese government will resolutely clamp down on virtual currency speculation and related financial activities and misbehavior in order to safeguard people's properties and maintain economic, financial, and social order, the PBOC said in a statement. I think this is obviously a blow to for the short term to the crypto markets, but I believe that China is preparing basically to introduce their own digital yuan and may potentially be backed by gold. So this kind of maneuvers us as suspicious in that sense that you want to see what it is behind this moves politically, economically, and obviously China is trying to get control over the digital markets, but there are other alternatives, than China in terms of mining. Other countries supporting it. Obviously, El Salvador made Bitcoin their national currency. So we are definitely moving into another dimension that is highly technical, developing faster than any old regulations do not apply, any old philosophy, any old school of thinking does not apply. And one of the ways, obviously, that they try to control the market is by regulation. And, regulation is good because it does create transparency, clarity, disclosure. But when you go over the extremes, more or less, what China has done basically is, unless they are preparing to introduce their own technology, is basically preventing the Chinese people from moving forward in this society, in this world, which is becoming highly digital. And the transformation essentially is faster than we think in terms of how the digital world, the technical world, is going to capture basically the physical economy through blockchain and put things into more clarity, more perspective, know exactly, what inventory you have, where, and it's another form, basically, of managing all of the basically all ways that were used to manage economically, our physical business, basically. And this has taken transformation in just about every business across the board, as far as technology and the adaptation of technology. And it's not going to stop, for sure. It's taking a life of its own. So what we're doing here at the Equity Management Academy is using that technology basically to create the AI that gives us very high probability trades. Although again, technology is developing, we are also developing in terms of how we're using technology to help us manage these volatile markets that, fundamentally do not make any sense at all. Point in case, if we focus on the gold market, for example, fundamentally the gold market is in one of the most bullish positions, fundamentally, that we've seen in the history of this market. And yet the price has been suppressed to levels that do not relate to any market relationships with other products, and even Bitcoin itself, which has become a major force, a market force. The relationship is so skewed. If you take a look at the values between gold and crude oil, gold and copper, gold and palladium, gold and platinum, commodities in general, which have exploded, although we've seen a bit of a correction here, we are still facing tremendous supply chain bottlenecks, and I'm not so sure, how this thing is going to resolve itself in as we move into the holiday period, the holiday times, basically. So we're going to see, I believe, a great deal of volatility in the market over the next few months. The Federal Reserve Chairman Powell obviously has made clear that he's not looking to raise interest rates anytime soon. But the reality is such that there is a definitely disparity between the fundamental analysis that is being done and in terms of the market itself as far as any kind of economic growth. The unemployment numbers showed that people are filing more unemployment. The subsidies have ended, and now about 7.5 million people are at risk of evictions. That's not economic growth. That's not economic activity. If we shut down or for some reason we don't have the kind of Christmas that we are used to, that's not economic growth. And the risk is right now that some of the ships are waiting online, and there's like an enormous number of ships, 65, 70 ships that are cargo ships that they can't unload. They have labor shortages. It's becoming a real problem short term because the demand is unprecedented, obviously, as we go back into a normal economy once again. The problem is that we're not finding supplies readily available. A shortage in computer chips continue to be causing a lot of problems in technology, car sales, basically industries that, which is just about everybody uses chips. So obviously, if we take a look at the market, it's very difficult to trade fundamentally. So what we do here is we apply the VCPMI, which stands for the Variable Changing Price Momentum Indicator, that uses pivot points, uses moving averages, it uses wave counts, it uses Gantt formulas. It's a combination of independent, proven methods of technical analysis that are filtered into one component that's called the Variable Changing Price Momentum Indicator, that basically identifies for you the extreme levels above or below the average price. In terms of trading this market, what we do is we identify the different levels of support and resistance daily, and the algorithm activates this support and resistance levels with colors that represent mathematically a probability level that if the price reaches these levels, it activates an alert, and it tells you, listen, you're at a buy one daily of 1728. It is a 90% mathematical probability that if the market price rejects these levels, that we could see a reversion back up to the mean. And the daily mean is 1753. The weekly mean is 1770. So once we can extrapolate the average price, whether it be daily or weekly, then we can identify the extreme levels above or below mathematically. And when you get to the sell 2 level, or daily level here, which is what we saw yesterday, we were looking at about a 95% relative implied volatility to the mean. Once again, the mean is a 50-50 standard deviation, so it could go either way. And when it trades above it, it activates a bullish price momentum, and the targets are stipulated clearly above or below for the day, if you're day trading. For the week, we use the weekly signals, and we identify the market based on what it is or where price is in relation to the algorithm. And the AI tells us that when the market trades around the average price in green, it's pretty choppy. It gets very choppy. So you want to wait until the highest probability trades are identified. And that is essentially selling above the mean into the sell 1 or sell 2 level, or buying at the extreme below the mean of buy 1 and buy 2 level. Now, I integrate the daily and the weekly. And what you see here on the upper end of the average price is the sell 2 level of 1792 and the sell 1 weekly level of 1794. That's a pretty close harmonic relationship. This is the optimal mathematical probability level that if the price reaches and activates these levels, that it could revert back to the mean. The market tried with a high of 1788 on the 22nd to activate these levels, but it experienced supply a lot lower, at lower levels. At 1788, about 4 cents of the target that was anticipated. And so, in theory, it actually didn't activate the trigger point, the sell point. But you, as an individual trader, you have a certain discretion. And what I say to self-directed traders, including in my trading room, that you can use 10% margin of error so that you at least lock in a profit. Or if you get a signal, if you're in the long side, use a trailing stop until you get to your target. In this case, obviously, the trend momentum was met the target at higher, or I should say at lower highs, where the supply came in at lower levels than the targets, and it reverted back to the mean. And you can see the market trading around the average back and forth, back down again. What you see here is the market coming down below the weekly average. And that activates a bearish price momentum, and it automatically targets the level below, in this case, 1729. Now, in between, we look at the daily, and the daily is 1753. Trading above the daily average as well came in with a bearish price momentum and found buyers at a higher level. 1737.50 is where the buyers are showing up. Now, just to explain once again, the price momentum is the volatility of price within the trend of the market. And what we do here is basically show you the variable changing price momentum indicator and the extremes above or below that average for day trading, as well as weekly or intermediate to swing trading. And this is how pretty much I'm trading this market myself using this information to identify the highest probability trades. Let's take a look at Bitcoin. Excuse me. And what you can see here is that regardless of this Chinese news, which collapsed the market from 45,215 all the way down to the weekly buy to level of 40,923. The market broke through the average price daily, broke through the and entered actually the buy one weekly, the buy one daily, the buy two daily, and all the way down to the weekly levels of buy two level of 40,923. Now, the algorithm tells us that when the price is trading in blue, you do not go short, even though the market may come down, as it did, based on this news, but you want to use these levels to buy into and accumulate longs. This area in blue is accumulation of supply. Mathematically, it tells you this is where you add supply. So depending upon your profile as a trader, then knowing and having this intelligence, then you can begin to design and customize a portfolio for you that you can use derivatives if you don't want to trade in the futures markets. And we can take a look at some of these derivatives at another time, or you can see some of my videos, basically, which I do show and disclose what I'm doing here. But I think, just to go over this, the China news might have come in here as a tremendous buy-in opportunity. If you thought you missed these markets, I think these levels are giving you another chance, another opportunity for you to build what I believe could be a phenomenal value now that we've seen a correction across the board in digital assets and in precious metals. I want to thank you once again for the opportunity to share this info with you, and stay tuned every day at 7 a.m. Subscribe, like, so we can continue to provide you this incredible intelligence for you as a self-directed individual. Have a great trading day. I'll talk to you later. See you next time.